Sophia Castro, welcome to the Bigger Pockets podcast.
Hello there. Thank you so much. So excited for the invite to this podcast. Looking forward to giving all my knowledge and value to your audience. Really, really excited.
Yeah, so are we. Let's get started by giving our audience an idea of what your overall portfolio looks like. Can you tell us what type of assets you invest in and what your portfolio looks like today?
Sure. So you want the most recent one? Because, I've been in the industry for quite a while and I've changed our portfolio probably about 4 or 5 times now. But today we have a complete different portfolio than what I started with. So today's portfolio, we have about $750 million in our portfolio of core deals. And if you don't know what core deals are, these are more assets where their vintage is newer and needs no value adds. They're pretty, they're probably 10 years the oldest that I have in the portfolio right now. And our newest is something that is just been built only 3 months ago. And we actually have one that's being built from ground up, which is our first development ever. And that one should be done probably in the next 12 months.
So how many properties do you currently own and how many units in those?
So right now we have about 12 properties. Each of them carry probably the smallest one that we have at the moment is about 163 units. All the other ones are, the 300s, 400s. The largest one is 422 units in one property. We have right now about 2,500 units more or less in total.
Okay, wonderful. And are you using a syndication model to acquire these?
Not at all. At the moment, we have never used syndication. We've used our own money. We've been very blessed that we have created our wealth in a different business, and we were able to carry that on into real estate at the same time as having another business. So this business that we had that we've sold, and I'm sure we'll get into it, we were able to get the cash flow from that business and put it into real estate instead of spending it. We've decided to open, a different branch from the other business and just invest all of our money into multifamily. And now we've been doing this since 2003.
That is incredibly impressive. So I kind of wanted to ask here, just kind of curious. So you mentioned right now that a large portion of your portfolio, I believe you call them core properties, and you said that they're not really value adds. They're a little bit more on the premium side. Can you help me understand, I guess, the benefit of doing that versus going in and grabbing a value add property? Because I imagine on something like that, do the returns differ greatly because you're sort of buying it, already fixed up and ready to go?
Yes, definitely. So the core value deals, these are A asset class, very new vintage. So you come in not needing to do much. But so what is the difference? In today's market is completely different than it was many years ago. And the reason why we got into core deals, is because of the market. So what happened was we used to love value adds because value adds, you would come in, you knew that you would put in CapEx, and that you would increase the valuation of the property immediately, and also your cap rate would increase. But in this market that we went through after COVID, those value adds typically are your workforce housing, and those tenant base was the ones that got hurt the most when it came down to this market that was unpredictable and this, black swan that we didn't know we were going through. So when you wanted to increase rent after COVID, which the market was extremely healthy to increase rent across the board. It didn't matter if you were in an A asset or if you were in a D asset. It didn't matter. Rents were increasing across the board at the same exact speed. And it didn't matter what you were making. Your income was that you were bringing in. So what we were finding was that when we were increasing these rents to the value add deals, these tenants couldn't afford it. They wanted to, they didn't mind paying it. Their income just didn't match with the increase of rents. So what we were finding was that when we would underwrite these deals, they couldn't meet the 3 times income that we underwrite at. So we decided, hold on a minute, we didn't like the core deals before because you would buy these core deals at a 3% cap. Normally, that's what you would, where you would buy value adds at 6-8% cap, right? So we're like, oh, wait a minute. And also price levels, they're completely different. But in today's market, it doesn't matter, again, if you buy an A or a D asset, you're still buying at a 3% cap. So we're like, what are we doing? 3% cap, and you buy a deal that you put 0 capex, or you buy at a 3 cap where you know that you have a heavy lifting to improve the property. Core value, your tenants are they're making a good amount of money on a constant basis. They're not having problems with their income. B, C, D asset tenants, they're not getting income increases, and they can't afford to accept the increase in rents. So we started evaluating our portfolio, and we're like, wait a minute, we need to change our core values here. We're going to switch out from value adds to core deals. And because of those things, and one of the main reasons is that when we underwrite our deals, and we always underwrite our tenants like if we're lending them a loan for 12 months. So not a lot of people like to underwrite their deals once they're renewing those leases. So you get a lot of, evictions or late pays, and it's a lot of work when you have to do all those things. So because of that reason, we started looking into core deals. Now, not a lot of people, when they're in multifamily, they can't afford to move up to core deals just because it's, of course, more expensive, but the rate of return on your money are the same in this market today is the same. So we did the stretch. We sold out some of the apartments that we had that didn't fit that core values, and we disposed of those and purchased new deals that fit the new core value that we have in our portfolio.
So if I'm hearing this correctly, I mean, there's obviously it's very nuanced, but with the core deals, very stable, secure, and just an easier target or like an easier demographic where you can increase rents, and they do it because they have their better professions or whatever it may be, a better livelihood. Whereas on the value add side of things, because of the amount of rent increases that were happening during the last year and the couple of years ago, when you go and add value, they can't necessarily keep up with like the quote unquote inflation of like the new market rent. Is that about right?
Correct. Exactly this. Yes, exactly the scenario.
Okay, great. And so one of the things you talked about that I just wanted to get some clarity on, because I know there are a lot of people listening here, we do talk about cap rates quite a bit. So do you think you could just give us like a quick rundown of the concept behind a cap rate, and why a 3% cap would be significant in one of the deals that you were talking about?
Yeah, so cap rate, like I'm sure most of your audience knows, it's the return on your cash money. Like you're not putting debt on the deal. This is if you're going in, purchasing the property with no debt. That's what your cap rate return is. A 3% return is if you invest $1,000, which you have to buy the property in full with no debt, you're making 3% on that $1,000. Of course, you're not buying no deal at $1,000, but I just want to make it easy for people out there to do their math. So when you're buying a deal, your return a 3%, and you're saying, if I have to put in this much work and it's going to be a heavy lift and I'm going to make a 3% on my money, or do I want to buy something a little bit more expensive, still making 3%, but I'm not putting in that heavy lift of having to improve your tenant base, the whole 9 yards? Which one are you going to pick? So that, based on cap rates, is your return on your investment. So you want to be as smart as possible. You want to, try to work at smarter than harder when you invest in a property. So if you're going to get your same return, where would you go? Heavy lift or easier lift? So that's how we evaluate when we look at our cap rate, is the heavy lift that you're going to put into it to get the same return.
I think a lot of people ask the question, why would you ever buy something at a 3 cap or a 3% return? if there was no financing versus a 6 cap where you could get twice as much. Especially new investors, this is the question they're all looking at, is how do I get the highest return on my money possible? And I've always understood cap rate to be the desirability of the cash flow. So the more desirable the cash flow is, the lower the cap rate's going to be, because the more competition there will be for that asset. And like you're mentioning, like a really nice core, maybe we call it luxury property, where you're getting the best tenants and the rents go up the most and you have the least headaches and you can run it with the least, like what you called heavy lift, the lower the cap rate will be, because that is a more desirable cash flow than if you get a higher cap, but it's a lot more work to do. And I'd like to differentiate here, because what you're doing is the goal of every investor. It's you started off grinding and adding value, and like what you're talking about with apartment complexes, improving the units, raising the rent, and then probably refinancing at some point, is sort of like the Burr method for multifamily. Correct. We would use that in the single family space with a rehab, but it's work that you're doing. When you get to the point where you can put your money into properties that don't take as much work, but that maybe have a lower return, that's actually where most investors are trying to get to. And then I'm curious to get your opinion on your experience when you do get something at a lower cap that's a nicer property. Do you find that over a 5 or 10 year period, it catches up to and passes what would have looked like a better return on a value add property in the beginning?
Yes, so it's a little bit of a, you can't, yes, you do find that later on it does increase more. Mm-hmm. And, but for those beginners out there that want to get the cash flow, for us is our number one. That's all we look at, the same way as when we first started. When we got into this into investing in multifamily, our number one was what is going to be the cash flow for this property. And that should be everyone's number one. So when we used to buy at the very beginning, we were buying very small duplexes because we had the mentality that we wanted to buy the properties cash, right? That was just a mindset that you're going to get more return on your money than leveraging it with the bank. As we went on, we understood that leveraging the proper way, because you could leverage wrong and a disaster could happen. But when you leverage correctly, your cash flow and later on the value to the property is going to be way better if you do leverage yourself than buying all cash and trying to go after that the cap rate. So cash on cash return is really what we look at also, because we don't buy all of our properties free and clear. We definitely leverage across the board, just because we could be buying more property and having more cash flow when you leverage. But yes, so when you do buy, like say value adds, and you do improve these property the proper way and don't over improve them, you do get a better return on the long run, because you're able to improve that property you're buying it at a lower valuation, where they're missing out what that cap X that you're going to put into it, and then you could quadruple the value if you do it correctly. So yes, value adds do give you better returns on the long run, but core values are deals. The core deals, you're able to have a more steady return, and it is favorable on the value increasing also. So it really depends on what market you're in and what you're investing for. So many different core values for investing that could, value adds are great. Core deals are great. What are you in it for? Long-term, short-term? Are you wanting to do those value adds so that you can increase the property value and get a nice chunk of return in the next 2 to 3 years? Value adds your deal. When you buy core deals, your values are not going to increase as rapid as your value adds, because of course you just bought a property that it was below value and you're increasing it. So again, it's a hard question to answer, because there's just different core values that you're investing for, but they're all great.
Yeah, that all makes 100% sense. It's very relevant for me, because we just went into escrow on a hotel in New York, and it needs a lot of work. And they were trying to sell it to us at a 3 cap. And we're like, well, no, I don't think so. This is going to need a significant remodel. So we've been going back and forth, and we finally landed on a price. But if we pull it off, then, it'll increase substantially over the next couple of years. So very cool. Thank you for the masterclass there on cap rates. I think a lot of people are going to appreciate that at home.